Excellent. So we are recording. It is Monday, May 26th, I believe, 2025. Welcome to this Pareto Business School launch webinar. I think we can label it on financial statements, the 80/20 of financial statements. There might still be a few people joining. That's totally fine. We're going to get started because we're all about effectiveness and efficiency at the Pareto Business School. So welcome, folks. The way we're going to do this is, if you have any questions, which we do really hope you have, otherwise we'll be super unhappy and we'll break down crying. So please have questions. Do post them in the chat, and we'll pick up on them during or after kind of the slide show here. So we're not going to interrupt as such with questions, but we do want questions, so do write them. And then towards the end, we should have some amount of time for kind of addressing those and doing the hand-raising function and sort of additional questions. So this is the hand-raising function in Google Meet. So let's get down to it. Financial statements 80/20. This is our take on that. And of course, for the full financial statements and kind of business learning experience, you are kindly invited to have a look at the Pareto MBA program. But we're not really gonna, this is not like a sales occasion for that, so we're not gonna waste your time talking about the program, which is great. Okay, financial statement basics. Let's start with some basics. Financial statements, and we'll get to what they are supposed to give a fair representation of a firm to its stakeholders, of a firm's health. So you could say it's the financial health of a company. And it's not a coincidence we're using the word health here, because actually it's sort of similar to a health check that you might do as a patient or as a human being. And there's also the thing that we use double entry bookkeeping or double entry accounting when we do this. And that's an old invention. We argue it's one of the great inventions of humankind. And it minimizes errors because you put everything that happens in two places. So it has to balance, and we'll kind of get to that as well. But yeah, it should give a fair representation. That's what financial statements are all about, to different stakeholders. And again, we'll get to the health part and we'll get to the stakeholder part as well. Anything that happens, all or definitely most transactions in a company are recorded. For example, what happens in bank accounts, you have to record those things. The flow of money is recorded. Some things that don't happen are also recorded. Sounds a bit counterintuitive. We'll also get to some examples of that. It's important to know. Now, financial statements are a form of storytelling, and a lot of people don't really get this, or they don't think about it that way. They think about the financial statements as being sort of set in stone, and it's an objective truth and so on. And it sort of should be close to that, but still financial statements are a form of storytelling. That's also why it's kind of highly regulated by lawmakers, parliaments, and so on, because there is some room to do things here, and we'll get to that as well. And somebody like Warren Buffett, the great investor, maybe the greatest investor who ever lived, maybe, he calls EBITDA, for example, bullshit earnings. So EBITDA is one of those kind of accounting or financial metrics we'll mention as well. So you can use this stuff for storytelling. Now, financial statements, which is the numbers, they are part of an annual report or some kind of report typically. And you also have the CEO typically writing a shareholder letter. They have an earnings call when they report earnings if it's a publicly traded company and so on. So the financial statements are an important part of this. But again, it's the company is telling a story about itself. Super important to understand. The three main financial statements, we'll kind of repeat this over and over again. The three main financial statements are the balance sheet, the income statement, and the cash flow statement. The balance sheet is what it sounds like. It has to balance. It shows the assets, liabilities, and equity, and we'll dive into those as well. It shows the company at a point in time. So it's a snapshot at a point in time. So usually the last of December could be the last day of a quarter or last day of a month, whatever, or any in between, but it's a point in time. Now, the income statement, it talks about the firm's ability to generate profits. It talks about the profitability of the company. You could refer to it as a statement of operations as well. It's another sort of a name for it. It's used a lot in the US, statement of operations, and we'll see that. but it's really the income statement. It has revenues and expenses. So it's stuff that you sell, and then the expenses that you incur while you are generating those revenues, and then you end up with some kind of profitability there. And it shows a period of time, usually a full year or a full quarter or something like that, but often a full year. Then there's the cash flow statement. The cash flow statement, and you might think, isn't that the same as the income statement? No, it's not. It shows how the firm's cash position is changing during the year. So it's another statement which shows a period of time, right? It has cash flow from operations, cash flow from investing, and cash flow from financing or financing, if you prefer to pronounce it like that. So yeah, it's really showing the cash flows. Why is the cash flow statement necessary? Well, we'll see also that there's a bunch of different things that are in the income statement which are not in the cash flow statement, and the other way around. And really the point here is that you kind of need all three of these to get like a decent idea of how a company is doing. But again, the balance sheet point in time, while the income statement and the cash flow statements are showing changes over a period of time. So what is the 80-20 of this? Because that's the label we put on this webinar. Well, first of all, 80-20, when we talk about that, it relates to why we are called the Pareto Business School. There's an Italian economist called Pareto. I'm not allowed by Jens to talk too much about history here, but he was born in the mid-19th century, and he realized that he's the first person to kind of to show this statistically or through numbers or empirical investigation that 80% of the results or outputs or the wealth or something like that is generated or owned by 20% of the inputs. In his case, he was looking at land distribution in what was then Italy, or the new nation of Italy. Anyway, so it's the 80-20. It's like a big share of the outputs come from a small share of the inputs. So we argue that this applies also to learning. So what is then the 80-20? Well, so we remember that these three main financial statements, they describe different aspects of a company, like a health check, right? We have something called the matching principle, super important. It means we allocate things to time periods. We just don't book it exactly when it happens. We have to think about, okay, what time period does this refer to? If we buy if we're a chocolate factory and we buy a bunch of cocoa beans in December 2025, we're not allowed to allocate that as an expense in 2025. We need to allocate it to when we use those cocoa beans, which probably is going to be 2026 or something like that. So the matching principle, you have to allocate things, right, to the correct time period. And then we're saying this kind of many times over, but income or profit, same thing. Income and profit, same thing. Is not the same as cash flow. A word on words. So everybody knows the word profit. Now, the word income can be confusing to people. Income is the profit. It's not the revenue. So some people confuse revenue and income, but income is like the bottom line, while revenue is sort of higher up. So what's actually important? Well, margins are important. We'll have a look at that. That relates to a concept called moat or a moat, which is a protection around your business. You want to have a moat around your business. We talk about that a lot on the Pareto MBA program as well. Cash flow is important. A good investor or a good analyst will look at cash flow. Leverage is important. It's how much and whether you have a debt on your balance sheet. We'll see something about that as well. Now, also, like, you don't just look at one balance sheet or one income statement or one cash flow statement. You look at how the things develop over time, not just during 1 year, right? So the income statement and cash flow statement, they are during typically 1 year, show the changes or show what happens during that year. You also look at how these things change from 1 year to the other. Then sort of the next level stuff here is to think about returns and capital allocation. We're not going to go kind of deeply into that here, but really investors and good managers, good CEOs and good management teams, they think about, okay, when we do all these things that we do during a year as a company, kind of, does it make sense? Like, do we generate a good return on our efforts? So that's really kind of the next level to think about that. That's super important. That's really like the core, like capital allocation is like the core of the economic system that we have, capitalism. So again, just to reiterate, the balance sheet here, if we start on January 1st, the balance sheet is going to be the same as the balance sheet which was on December 31st. And so this is a starting balance sheet of the year, which is the same as the ending balance sheet for the year before. And then here you have this year's ending balance sheet on December 31st. So you can sort of see, and then you have the income statement here, and you have the cash flow statement here, and they show everything that sort of happens in between, everything that's relevant that happens in between, right? From this different aspects, different perspectives on the firm's operations here. So you travel, in a sense, you travel from one balance sheet on January 1st to another balance sheet. And these two statements, the income statement and the cash flow statement, they tell the story of what really kind of happened during that year. So again, you have the idea of kind of storytelling here. Now, we cannot not have Harold in this presentation here. Hide the pain, Harold. I think we can all relate to Harold. So Harold here, so imagine that Harold is the patient, and he goes to the doctor. And Harold, on January 1st, he has some body weight here and some body fat here. He weighs 90 kilos and has 25% body fat. And then during the year, he does a bunch of things. Like he eats things, and then he burns those calories or some of them. So you could think of that as your income statement. We're mostly saying this to kind of help you remember stuff. You might completely fail, but we believe this is a useful kind of allegory. I guess maybe the term is that allegory?
Analogy?
An analogy, yeah. Right, so think of it as a health check. And then you have the cash flow statement. You have some other stuff that he does, kind of workouts. He buys, gym card, running shoes. He gets some sleep, meditation, whatever. And then he ends up with another balance sheet at the end of the year, right? So in this case, Harold, he lost weight and he lost some body fat. So we had a health check at the beginning of the year. We had a health check at the end of the year. And these two statements, they kind of tell the story of what Harold did, like in between here, how he ended up with this other balance sheet. You could argue that the balance sheet is the main financial statement, if you wanted to. Somebody like Warren Buffett would say, yeah, like the balance sheet is the shit. Like that's what you really should look at. That's the first thing you look at. Some different opinions on that, but it's really, you're not gonna make a fool of yourself if you say the balance sheet is like the main thing. But this is still Hide the Pain Harold here, and he still starts on January 1st with this stuff. So actually this year if we look at the numbers, it's not a great year for Harold. He eats a bunch of calories, he doesn't burn them, so he has a calorie surplus. He doesn't go to the gym, he doesn't buy any running shoes, he gets too little sleep, and so on and so forth. So he actually gains weight and he gains body fat during this year. But he can do, the point here is he can do whatever storytelling he likes, right? He can still say that he's an amazing guy, but we have to look at the numbers. So again, it's about the storytelling that the patient does, that the company does. The company can say, we're doing amazing, but then you look at the numbers and it might not really make sense. It could be the other way around. The company could tone down how well it's doing. It could say like, it's going okay, but it's not going amazing. But if you look at the numbers, it's actually kind of going amazing. So you could have the other case, the opposite case as well. But yeah, again, financial statements are a sort of a health check for the company health status. If you talk about the balance sheet, and then these other statements, they kind of show how you end up with that. But again, showing different aspects, that's like really the point here. And you cannot just look at the weight of somebody or their blood pressure or their heart rate or whatever. Like you have to sort of look at a lot of different aspects to understand the health of a patient. Yes. So let's dive. We're like 15 minutes, I believe, roughly into this thing. And so let's dive into an actual financial statement or one of them by an actual company. So this is Spotify. We all know about Spotify. Spotify sells music. This is the latest annual report by Spotify. So we can see here it's like per December 2024, and it's the 12 months, so it's the full year. And they are comparing, obviously, to the previous year, so 2023. Now, they call it a consolidated statement of operations. It's consolidated because they have a bunch of different subsidiaries, and they kind of put them all together here to give like a complete picture of Spotify. Like, so they include whatever their subsidiary in the US and Sweden, and maybe they have a company in Luxembourg, what do I know? And so they put all of those things together. That's why it's called consolidated. Statement of operations is the income statement. It's just called that in a lot of places in the US. But okay, so here we have a bunch of different numbers. You have the numbers for like 2023, 2024. The income statement or the statement of operations, it starts with the revenue on top, and then down here you have net income. So this is the net profit, the net income, right? Then you have some earnings per share and stuff like that, but that's like fancy stuff. We don't have to talk about that too much. You see that, so they're a publicly traded company and they report, and so it's important for financial analysts, for investors to understand that. But yeah, revenue on top here, net income at the bottom, right? Also called the bottom line. But how can we make sense of this? We just see a bunch of numbers. We see like this number is going up, like other numbers are going down. How can we sort of understand this? Well, this is what an investor or a financial analyst might look at when it comes to Spotify. So it's not so much about the actual absolute numbers. It's more about the change. Yeah. So we can see that revenue grew 18.3% between 2023 and 2024. Now, here we have the idea of the gross margin, which we kind of mentioned. We mentioned margins before, that we look at margins, right? The gross margin is super important. The gross margin used to be sort of 25, 26% here, 2023, and it grew to 30%. So they're doing good in terms of the gross margin. You know, the expenses, if we have a look at that. So the expenses as a share of revenue used to be 29%. Now it's 21.4%. So they cut down their expenses as a share of revenue. And they have net income here, which they didn't have net income last year. The net income last year was negative. When you see a number in parentheses like this, it means negative. Might be trivial, but worth sort of saying. So they actually turned a profit here in 2024, and so they increased their net income a lot, and they ended up with 1.1 billion euros net income. And here you also have the profit margin. Like, they don't write it themselves. You have to kind of calculate these margin measures yourself. But okay, so fine. So now we have some margins and some stuff like that. What can you actually say about this? So this is again what an investor or an analyst might think, or Spotify itself. Maybe Daniel Ek would say something like this. Okay, so we increase our gross margin, we keep more. Like when we sell music, we keep more of the revenue, either because we increase prices or we pay less to rights holders, or maybe a combination. We grow revenues while we cut costs. Yeah. Okay, so those are kind of statements of fact. What does this indicate? Well, Spotify might have pricing power, which means it can increase prices. Maybe there is not so much competition. Yeah, so that's a good thing. Spotify might have pricing power. Strong execution, well, because again, we managed to grow revenues while we're decreasing our costs, or rather expenses, right? We might have network effects. Maybe it's the case that one of the reasons why our expenses are going down is because marketing happens by itself, because people share their playlist and so on and so forth. So there might be network effects. Now, the kind of conclusion from this is it looks like a good business model, but maybe the profit margin is low. We'll kind of get back to that. But this is an income statement of operations. And this is only one of the three financial statements. So maybe there's something we're missing here. Yeah. And so again, like, instead of talking about kind of theory, we're throwing you out the deep end here and like looking at an actual company and their actual numbers. But yeah, is there something we are missing here? Let's look at the balance sheet, which they called the statement of financial position. But this is the balance sheet. And again, it's a consolidated one for the Spotify group. So what can we say here? Like the balance sheet, to start with, it's divided down the middle here, yeah? So on the left-hand side, you have assets, And on the right-hand side, you have equity and liabilities. We'll get into that as well. But the balance sheet is split down the middle, and the left-hand side must balance with the right-hand side. So if we look at 2024, you have 12 billion here, and then you have like the same kind of down here with the 12 billion on the right-hand side. So balance sheet has to balance. What can we say about this? Well, if we look at cash, so again, what would we look at in a balance sheet? We would look at cash, for example, so cash and cash equivalents. It's actually increasing a lot from kind of 2023 to 2024. So it looks like they're getting like 1.6, 1.7 billion more cash, but it's actually even more because they have like these short-term investments that are actually also growing kind of strongly here. So the actual cash increase is like more than 3 billion. Maybe they raised a bit of money here. It looks like they raised around 1 billion. Maybe they borrowed some money. We have like these notes, which is their kind of liabilities. So, yeah. So again, what you might look at here, there's a lot of cash. There's not any debt, basically. There's some debt, but sorry, the cash is like more than 7 billion, 7.5 billion. Even if you deduct the debts, you still have 6 billion. So it looks like a healthy balance sheet, unlike my voice. So there's still one more financial statement, which is the cash flow statement. So let's look at that. So again, you have 2024, 2023. Yeah, sorry guys. I didn't party or anything on the weekend, but yeah, something happened with the voice. So this is showing part of the cash flow statement, which is about the operations. So here we have the net cash flow from operating activities. What we can say here is they actually generated a lot of cash flow. So again, this is the third financial statement we're looking at. And so you can sort of say that these kind of add up. The income statement was looking okay. The balance sheet here is healthy balance sheet, and they generated a lot of cash here. So lots of operating cash flow. They have a decreasing working capital. We might talk a bit about that as well. So this is kind of receivables and other assets. So they became kind of more efficient. They have less working capital, and that's good for cash flow. So that's one of the things you look at. Now, we said it's about storytelling, right? So far we just looked at the numbers, and here's actually what Spotify themselves are saying, right? So you can see they talk about strong performance here, exceeded guidance, record profitability, like exceeded guidance, outperform, surpassing guidance. So basically they are saying that they are doing great, right? And so you have to look at like both the numbers and what they tell about the company to kind of figure out how they are doing. So again, it's storytelling. You can do storytelling with numbers, or you can do storytelling with words. Again, you are regulated, so you can't do whatever you want, but within certain bounds, you can do it. And of course, they talk about their like monthly users and all the rest of it. So this is kind of what drives the financial statements. This is the underlying stuff. You don't put users in these like three main financial statements. That's important to understand. So it's part of the annual report, but not part of the financial statements as such. And they talk about the future here. They talk about 2025. They say that, okay, these financial statements were good, but we're going to keep doing good in the future. That's basically what they're saying. So if we kind of have a look at conceptually, what did we just see here? Yeah. So we looked at Spotify. This is the balance sheet, right? So it's the firm's assets and who claims them. So a company like Spotify, any company, it owns things which are tangible. It owns things which are intangible. It has cash, and it has like some receivable stuff like that. So when you sell something but you don't get paid, that's actually an asset for you. Yeah. And again, this balance sheet is split down the middle here. So you have like on the left-hand side, it's what you own. Now on the right-hand side, it's what you owe or whom you owe it to. So here we can sort of see that the government is a stakeholder. We'll talk more about that. Employees, lenders like the bank or whatever who lends you money, suppliers. So you might owe taxes to the government. You might owe salaries to your employees, bank loans to banks, and kind of payments to your suppliers, right? And then here at the bottom right, we have the shareholders, the owners. Now, in the case of Spotify, they actually put the shareholders up here on the top right. Yeah, it doesn't really matter. Typically, you would put them at the down on the right here. But yeah, and we'll kind of get to that and why that kind of makes sense. Now, this is what's referred to as a fundamental accounting equation. So you have assets is equal to liabilities plus equity. So you have assets here equal to liabilities plus equity. Yeah, and if you move things around, you can sort of isolate equity. So equity is equal to assets minus liabilities. And this is actually a deep and profound point that we're making here. So equity owners, they get what's left over. Yeah. So they don't have a claim. They don't have a prioritized claim. But if the company does well, the company pays the bank and its employees and suppliers and so on, and the government, then the shareholders might get something. So yeah, this is kind of a fundamental thing. Now, if you kind of have another look at kind of what's important here to kind of reiterate, yeah. So in the balance sheet, you look at like, is there any debt? You look at cash, you look at working capital, you compare year over year, yeah. The income statement, you would look more at the margins, the absolute margins, which we did already, and relative to competition, which we might get to. In the cash flow statement, you look at how much cash the company is generating. You look at whether they actually raised money or if they repaid money. We didn't look at that in this case, but you would do that as well. And you would compare year over year. These year over year comparisons, if you're in doubt about what to look at, you can always compare this year to last year, and you can say something about that. Yeah, and what do different stakeholders then look at? Yeah, so everybody's looking at these kind of big things like growth and margins and cash flow, debt, that kind of stuff. Yeah, but then there are some specific aspects here. So the owners, the shareholders, they might look at the net profit because that's what's left for them after everybody else has been paid. They might look at dividends, which is money that you pay out to owners, right? And which we kind of mentioned before, but if you would look at kind of the returns here, we're not going to talk about that in detail, but that's what kind of owners might look at. Operators, which is kind of management, yeah, the people operating the company, they might look at these kind of down and dirty metrics. So kind of gross margin, operating margin, working capital, kind of, do we generate cash? Like, do we convert our invoices to cash, right? Lenders, like the bank, might look at kind of leverage, cash flow. This EBITDA term comes back here. So EBITDA is earnings before interest, taxes, depreciation, amortization, which is the idea of EBITDA when it was started to be used in the 70s, was to kind of show cash flow or to be close to cash flow. Now, the government wants to know if the company is profitable because you pay taxes on profit. So they care about how you recognize revenues and costs. And when you recognize a cost, it's called an expense, right? Suppliers look at, well, they look at cash flow because they want to know if you have cash to pay them. And they look at the accounts payable, meaning how much you owe to other suppliers, right? Because they want to see, like, if you don't pay other suppliers, maybe you're not going to pay them, right? Now, it's worth highlighting a few things here. So operators, meaning, again, management, for example, yeah, there might be management bonuses. So management might want to show sort of high profitability to get high bonuses. Yeah, so that's something, or high EBITDA, for example, if you have EBITDA-based bonuses. So they might do different things to boost the EBITDA or to boost profitability in the short term, while not caring about profitability in the long term. So that's like one battle there. Another thing is the government. So the government wants you to pay taxes, and if you try to push down your taxes by having a lot of expenses, the government might not like that. So here you might have an incentive to kind of push up the profitability, and here with the government, you actually have an incentive as a company to push down your profitability, to make the company not as profitable, right? So the point here is to show that you have all these different stakeholders, and they kind of pull the company or the accounting department, they pull the accounting department in different directions, right? That's something to keep in mind. So you have different pressures on the people doing the accounting or putting together the financial statements. Now, just to sort of mention a few things that might be counterintuitive at first. So everything that happens and some things that don't happen, again, they are recorded in two places. This is called double entry bookkeeping or double entry accounting. And it's a mix of abstract and real. So really, when you perform a haircut or some kind of service, that's revenue, which is something abstract. You might get paid in cash, which is something really real or concrete. Could be sort of the other way around, like you have some things that are not that don't correspond to money flows, to cash flow. So depreciation of a building. So when a building kind of loses value, or it gets dilapidated, is that the word, over time, it gets worn down over time. That's called depreciation. That's not a cash flow, but you have to show it in accounting, sort of in the company's accounting. Again, another thing which we mentioned already is the income statement and cash flow statement. They are show a period of time. The balance sheet is a snapshot. Super important to keep in mind. And this point, again, like we mentioned it, but yeah, cash flow is usually not equal to income. Sometimes you might have more cash flow than income or profit. Sometimes the other way around. Spotify historically has had more cash flow than profit. Might sound counterintuitive, because a lot of the time you have more profit than cash flow. And then you might ask the question, okay, why are you reporting these profits when you are not able to back it up by cash flow? So that's something that investors would look at. For example, some more examples. So when is cash flow not equal to revenue or expenses? So this is the stuff that drives profitability, right? Well, you might have revenue but not cash flow. Again, you deliver something, you perform a haircut, but they don't pay you immediately. They pay you after 30 days. So that's revenue but not cash flow. You might have something where it's an expense but not cash flow. So you remove something from your inventory to generate revenue, right? So you have to remove it from there, but it has nothing to do with cash. Depreciation is another example. You might raise, and this is an interesting point, you might raise money that generates cash flow, but it has nothing to do with revenue. Super important for any kind of entrepreneurs out there. So if you get an investment into the company, it's cash flow for the company, but it has nothing to do with revenue. And it's kind of a trivial point, but it's worth pointing out, because sometimes you see sort of people mixing up, and you see the headlines, a company raised 100 trillion, bazillion, gazillion, and it looks amazing, but they might not have any revenue or not a lot of revenue. But still, they are sort of referred to as a successful company. So that's something to keep in mind. You might have cash flow out, meaning you spend money, but there is no expense. So if you buy inventory, or if you build a factory, buy a factory, that could be examples of that. Some things to look out for. Well, is the company growing? Is it growing revenue, or is it growing profits also? Obviously, look at that. But yeah, margins, again, is the company profitable? And these 2 points here are kind of important. Is the company's gross margin, or margins in general, better than the average of the industry? So when we looked at Spotify, we just looked at Spotify in isolation. We didn't talk about any other companies in the same industry or any other companies. So we know that Spotify looks like they're doing okay, but we didn't compare it to anybody yet. So we don't really know. Everything is relative, right? As an investor, I can put money in Spotify, or I can put money in some other company. So I sort of have to compare. And then this point, like, is stuff improving or worsening over time? Yeah. So you have to compare across years. Debt to equity, this is the kind of the leverage. Like, do you have any debt on your balance sheet? Is it a healthy balance sheet or not? Net working capital. Yeah, that's a sort of a technical thing there again, but yeah, like, how much capital are we binding are we locking up in our operations to operate the company? If we look at Spotify then again, yeah, so we have all of these different metrics that we produced. We calculated like the gross margin here, how much expenses they have as a share of revenue. We know that their profit margin is 7.26% in 2024, but there's one more thing. Netflix's profit margin is 27.4%. So now does Spotify look good? So it looks amazing when you look at this stuff. They're growing fast, like increasing margins and making a profit here. But if you compare it to Netflix, it's nothing, right? Like, oh, it's not nothing, but it's not as amazing as Netflix. So, and you could argue, okay, Netflix sells movies or streaming visual content. Spotify sells streaming music and some other stuff, but mainly that. You could argue about whether they're in the same industry or not, whether it's comparable or not, but probably it is comparable. And so Netflix has a much higher, this is like a net margin, so it's the bottom line margin, like the ultimate final margin, than Spotify. So you would sort of have to do that comparison as well. Now, Spotify is much smaller. They might have a long way to grow and so on and so forth. But yeah, you cannot look at a company in isolation. Again, you cannot look at just one financial statement. You have to look at least the three main financial statements. You have to kind of listen to the company, do their own storytelling about the company. But then you also have to kind of look at other companies to have an idea about, okay, are these numbers in the financial statements any good? Right, so you have to compare it. Now, to round this off on a positive note, I think we have like the Lord of the Rings and Harry Potter are like the two like approved movie franchises in the Pareto Business School. So what can we do here that's kind of a bit, what can we do to change these numbers? Because I've been talking all the time here about kind of storytelling, yeah? So what can we kind of mess around with here? Well, we can like recognize revenue too soon, yeah? So we made a sale, maybe we didn't send the invoice, maybe the timing on the invoice was correct, maybe I'm the CFO and my CEO comes to me and says, dude, like the second quarter here of 2025 is looking pretty tough for us. Can you help us like make the numbers look better? So then I might take an invoice which actually should relate to the third quarter, so July, August, September, and I'm like booking it in the second quarter to make the numbers look kind of better, yeah, in the second quarter. There might be a head of sales, and I go to the head of sales and I say, like, do you have anything for me? And he or she says, well, you know, we have some clients here, like they are close to signing, but they didn't sign yet. And then I go like, okay, let's, you know, recognize that as revenue. We might have some real estate. Maybe we own a building and we can increase the value of that building on our books. Like nothing happens to the building itself, but we just change the accounting value. And that has a positive effect on the income statement. We can take some of our R&D or marketing, and we can classify it as an investment instead of as an expense. So suddenly we are much more profitable. We can use these alternative metrics. And you see this EBITDA again, or adjusted EBITDA, very common, or even community adjusted EBITDA and so on. So if your metrics are not good, talk about other metrics, right? Then you can even go full banana here, and you can like start to move things off of the balance sheet, or like not account for things, or kind of make things up. This has happened in reality, and there's an amazing movie about this company called Enron, called The Smartest Guys in the Room. I highly recommend it. Maybe not so much for inspiration, but it's an interesting documentary. So you can kind of really, really go crazy. And if you have a balance sheet which is not healthy, which is what they have, right? Like then you just move things off of it to make it look more healthy. Right. And
this is illegal.
Yeah,
Please don't do it.
Don't try this at home. But yeah, and then we're back to Harold here. So I think that's it for like the run through. We're at like 40. I think we took like 40 minutes. We started a couple minutes late, so which is fine. I think let's just open it up. Like we can kind of go deeper on any of these things. We can double click on any of these things. If no questions, maybe I'll kind of do that anyway. But yeah, please guys, ask anything you'd like to ask about financial statements. I'm going to be awkwardly silent until somebody asks a question. Jens, you have a question?
Do I have a question? Well, so this might be a lot to take in, obviously, right? I mean, and that's why we have our program that gives you slightly more over 8 weeks, of course. But we did want you to get sort of a glimpse of some of the things that we talk about in the program. It's worth mentioning and highlighting this thing that just happened. So we first looked at an example which might feel very scary, and then tried to take a step back and repeat what was just said. That was made on purpose to sort of to give you a feel for, you know, being thrown into the deep end, and then sort of breathe a bit. But yeah, what could we ask about here? I mean, obviously, I think there are some things that typically are that take some time until you fully embrace or understand when you look at financial statements. Like the difference between cash and profit, for instance. So I mean, I think it's worth mentioning perhaps that, you know, so this income statement, it really shows you the operations or the business as such. Is this a good business? So like you make money from selling goods and services, and then you deduct expenses, and then you end up with a profit. And that's something else from borrowing money to financing your business, or, you know, raising money from investors to finance your business. These are two different things, and because otherwise, if it wouldn't be, I mean, one way of looking good would just be to raise a lot of money or borrowing a lot of money, and that would show up as revenue, but that's not, you're not doing any business, right? You're just borrowing money. So it's worth having that thing. If you just make that distinctions, you come a long way, actually.
Yeah.
We have a question here. Do you think the reason Spotify was holding cash last year might be related to the recent acquisitions? Oh,
yeah, it's interesting. I mean, yeah, Spotify does generate significant amounts of cash, and they have done so over a number of years. So it's not only 2024, it's before that as well. I can't remember exactly when they turned sort of cash flow positive, but it's been a while, and they've generated a lot of cash. So yeah, so why does Spotify or companies in general hold cash on their balance sheet? Like, well, they could spend it on acquisitions, so it could be sort of in preparation for other acquisitions, right? Like, I think cash is very interesting because cash has some optionality. If you have cash and nobody else has cash, maybe times are a bit tough right now, and if you are the one holding cash, you can do things that other companies cannot. Yeah, so it gives you some optionality. So if there is even a big acquisition that Spotify identifies, then they can actually act on that. Yeah, I think, yeah, I think it's sort of, it relates to like the company philosophy. Maybe they have a somewhat more conservative company philosophy. Maybe Daniel Ek has looked at Zuckerberg, who made acquisitions like that generate a lot of value.
Yeah, I think there's another explanation too. Is the fact that Spotify has this freemium model, and so Spotify, you could use Spotify without paying for it for a while and with certain limitations. But Spotify still has to pay for the music that you're playing, even though you're a free user. So Spotify has actually, they have some limit to their growth rate. They cannot grow as fast as some other companies could. Like if you take Facebook or, you know, some other social media company, the limit to their growth is basically sometimes just the server costs. But Spotify actually has to pay for the music that users play. So obviously they do some things to sort of push you towards cheaper music sometimes, but also they might have cash as reserves to be able to grow, because to be able to pay out to rights holders when they grow through their freemium model and having their free users in there. That might also be a reason.
And you can sort of look, so these are the numbers for December 31st, so obviously 2024, sort of the final numbers. If you look at the latest quarterly report, which we did before this call, they still have a bunch of cash, even a bit more, right? So they have like 8 billion of cash and short-term investments. So they didn't spend kind of significant cash in the first quarter, but maybe they're like being ready to spend, right? But yeah, it's really interesting. A lot of these tech companies are kind of cash flow generating machines, and Spotify might be getting there as well. Henrik, please.
Hello, guys. Can you hear me?
Yes.
Yes.
Okay, thank you very much for a great presentation. I had a question about valuing assets. So in very asset-heavy companies, I feel like it could be positive overvaluing assets for investments, but I've also experienced that undervaluing your assets can bring a lot of resiliency. Let's say, for example, in markets with high rates, for example. So I'm just wondering how a company could balance that, and also I'm wondering how the valuation process is done and how it can be that, for example, buildings can be there's such a big difference in how they're valued.
Let's see if we can unpack a bit. Let's talk in general and then try and highlight the interest rate stuff maybe. But yeah, so a lot of this is regulated to start with, right? Like you have, in the US, you have generally accepted accounting principles like GAAP, yeah. And here you have IFRS, or sort of in Europe, you have IFRS. Not everybody follows IFRS because you're a small company or whatever, but if you go to sort of the big company type of accounting, IFRS or similar, then you sort of have to value things using market values as a general rule. So, but even in that case, right, like it's sort of, there's some flexibility in how do you value it? Like, do you value it at like 10 million, this building, or is it 9 million or 11 million? So you can like push things a bit, or you can be more conservative. But you should really value it at market value. But can you please reiterate what you said about, so in high interest rate environments, you wanted to have like a lower valuation?
Well, I think maybe it's more that you have more resiliency having that, at least my experience, because I work in insurance in guarantees, and we rate a company higher if we believe that they have a more a less exaggerated valuation on their assets, and my experience is that it varies a lot, and that's what I think is very interesting.
Yeah, okay, so that's a really interesting point actually, right there, right? So if we haven't maybe thought about it from an insurance company point of view, but if you're an investor, part of what you do is to kind of look at the assets of a company, and then you think like, okay, are these assets valued correctly? Are they valued, too highly, which might be the case, or even in the maybe more interesting case, are they undervaluing their own assets, right? And to be clear, it could be a physical asset like a building, but it could also be intangible assets. Like maybe they have a customer database which is highly valuable, but it's not really showing up in the balance sheet. Yeah, so you're trying to identify these undervalued or not valued assets. So yes, from a resilience perspective, if you want the company to be resilient financially, then in some way it's good if assets are valued conservatively. That's a good point. Then again, you're not allowed to be kind of too conservative, right? If you follow IFRS or something like that, then you have to value it at market rates. But this gets into a bit like of kind of jurisdictions and what accounting principles you follow. But yeah, that's an interesting point. Yeah.
Yeah, it also touches upon a related point about what is in the accounting and what can be read from financial statements versus what is this worth? What is this company worth? So, I mean, so you could take one of these super fast growing AI companies that we've seen lately, the Lovables and the Legoras and what have you. In their financial statements, especially before they sort of raised money and put a lot of cash in there in their bank accounts from investors, their balance sheet might look very, there might not be much in there. But then just a couple of months later, they started generating a lot of cash flow from users. Then you can't really put a value on this company based on what's in the balance sheet, because if you have revenue and profits, I'm not sure these companies are profitable, but if you have like growing cash flow or growing revenue, that typically is worth something. So the value of a company, as judged by an investor, typically has to do something with the cash flow that the company generating. And what do you think about the future of those cash flows? Will they grow? How much will they grow? When will that growth happen? And the closer to today you are, the higher you value it typically. And if you expect a high positive cash flow somewhere in the future, you value it slightly less or slightly lower. But it's typically not related specifically to what's on the balance sheet. Unless in certain circumstances you expect not so great cash flows and you expect this company to actually go bankrupt, you need to close it down and pay the debt holders, like the government and the employees and all of that, and you get what's left. Then you might actually value it based on the balance sheet, which is what some investors do. They buy companies close to bankruptcy, and then they just pay off the claims holders, and then they take what's left. So there are different ways of doing that, obviously.
And it's really worth emphasizing this point, right? So the balance sheet for Spotify, they have assets of 12 billion euros. I mean, the company is valued at, I don't know, 100, 150, I mean, whatever it is now. Billion, maybe dollars, but still, right? So the value of the company's balance sheet is in most cases not tied to the market, the so-called market capitalization, right? The market cap of the company. Super important point. And like Jens said, like you would look more at cash flows. So they generated operating cash flow of 2.3 billion. And if you look at their own kind of storytelling, they talk about something called free cash flow. So free cash flow, so they had almost 1 billion of free cash flow in Q4, and the free cash flow in the full year, which is actually, interestingly, it's basically the same as the operating cash flow, which kind of makes sense for Spotify. But anyway, it's like 2.3 billion. So when you would value Spotify, you would probably like put a multiple on this kind of free cash flow or on the profitability rather than look at the balance sheet, right? Which is true for most tech companies. For some real estate companies, you might be like more close between the balance sheet valuation and the market valuation.
And you see that this net cash flows from operating activities grows by 122%. So it's the cash flow is growing very fast. And so investors obviously try to make sense of will they continue to do so? Well, then this probably is worth a high multiple of the current value.
Yeah, and you would think, okay, so they did 2.3 billion of free cash flow in 24. Maybe they will do 3.5 billion in 25. Maybe they'll do like 5 billion of free cash flow next year, so 2026. And investors are forward looking. So, okay, so 5 billion of free cash flow in 2026. Maybe there's a 30 multiple on that, so the company's worth like 150 billion. Right? So this is how you kind of think as an investor typically. But really, it all comes down to kind of diagnosing the health of this company, not only using the income statement of operations, is what they call it, right? or the cash flows, or the balance sheet. Like, you have to look at all these different things. Plus, you look at some of these other metrics that they report, which is the monthly average users, for example. Yeah.
And we would refer to those as leading indicators, whereas the financial statements typically are the lagging indicators. They come, that's where you ended up. As a manager, you work mostly on the leading indicators, and these are different from company to company. For Spotify, they work on maximizing those monthly active users. For some other companies might be maximizing the sales pipeline of new prospective customers, and that's what you actually work on. The financial statements, that's where you end up. That you can obviously tweak them a bit, and if you go full Smeagol, you could do nasty things with them. You shouldn't. But mostly what you work on is the operational stuff, the leading indicators. We talk a lot more about this in our program, obviously.
Yeah.
So we gave you some glimpse now of some of the aspects that we touch upon and go deeper on, and hope you enjoyed it, and that gave you a hunger for more.
Yeah, and reach out to us if you have any questions on what we presented today, or on the program, or really anything. We're like super curious to hear. We're always trying to understand how people see these things as well, so we can kind of adapt what we do too. So yeah, thanks everybody for attending. I think we'll stop the recording and see you around. Please follow us. We'll probably do more of these webinars on like covering various topics. And thanks for the questions, guys.
So, bye.
Thank you.
Thank you very much.
Thank you. Bye.